All right, Jason, I wanted to sit down with you today to kind of just talk about market volatility. This can be a really scary time, I know, for your clients and really for everyone kind of in the United States with the stock market ebbs and flows and everything that's kind of going on with our economy. So I really wanted to sit down and talk to you about what your clients can expect during this time of volatility.
Yeah, so, look, volatility actually is a good thing, right? And most people don't quite realize that, right? We need volatility. Volatility creates opportunity and understanding that. But what I want our clients to know and what I work hard to do, so I do conference calls with them on a regular basis, stuff like that, where we talk through a lot of the psychology around how we feel about money, and we talk through a lot of the different variables that are happening in the economy and the marketplace and stuff like that. But I always want our clients to know, first and foremost, what they own and why they own it. And then secondly, I want them to understand why I'm saying what I'm saying. They don't have to fully understand all the ins and outs of it, but I at least want them to have an idea of, okay, this is why he's saying these things. This is why he's recommending these things. Because we're really focused on what's in the best interest of our clients, right? There's no incentive that we have to keep our clients invested during rough periods of time, right? So I don't have any incentive to say to people, hey, you should stay in the marketplace. It's not like I earn more money. In fact, quite the opposite, right? So really focusing on what their plans are. Are we on track to get there? If not, what type of adjustments should we make, if any, and those kind of things. So really having clients understand why we're doing what we're doing, why we're encouraging them to do certain things, right? And it's not always about what feels good or being comfortable, but it's about what's in their best interest.
So during times like this, I've actually personally heard the term, you haven't lost any money until you sold. Do you agree with that? Do you think that's correct?
Yes and no, right? The reality is when you watch the value of something that you own go down, you do have a loss there. The value isn't the same as what it was. But there is a very real difference between accepting that loss, meaning selling it and accepting it, and having it on paper. So a paper loss, right, is really just that. It's on paper. We're seeing the value of something go down. And, a lot of times people assume that things carry a value to them, right? Your home is an example. Everybody always thinks that their home is worth something, right? But your house is really only worth what somebody is really willing to pay you for it. And if we were to value your home on a daily basis, like we do stocks, like we do mutual funds, ETFs, those kinds of things, you might be a little bit nervous about what's happening, right? You're going to see fluctuations in that. So yes, I think it's still a loss, but realizing that loss, accepting it, right? I think is where we get into trouble, right? A lot of people, and if you look at inflows and outflows of money in the marketplace, a lot of times you'll see an interesting phenomenon happen, and that is people do the opposite of what they always preach, right? They always preach buy low, sell high, right?
Right.
And everybody knows that. They run around, they say this, they're excited about it, like all of a sudden they're geniuses at investing, right? And that's the idea, right? Now, hopefully you can do that, but the majority of people actually buy high and sell low, and that has to do with loss aversion, our fear of losing, and assuming that things are going to continue on like they are. We anchor to events, right? I think I saw a study one time that showed that most of the money invested going into early 2000 was going into tech, despite tech having shot up the year prior, right? All the warning signs were kind of there to say, hey, these things are getting a little overextended here, right? But we have a fear of missing out as humans, right? We have these different biases, we have these different emotions. We have the fear of missing out, and we have loss aversion. So we don't want to miss out, so we jump in when everything looks good, and then a lot of times people sell out when everything gets bad. And for people that say, well, we got to get out, right? My question is always this: is okay, if you get out now, when do you get back in? Because if you're moving because of fear, that fear is going to continue moving forward, regardless of what the market does. The market can start to rebound, and in your mind, you'll probably tell yourself a story as to why it's not going to hold that, why it's got to come back down. You hear people say, "Oh, the market's at an all-time high, therefore it's got to go down." Well, why? It doesn't have to. In fact, if we look at 2008, till now, is the market higher? Yes or no? Is it higher than what it was 2 years ago? Yes. And so on and so forth. So, we continually climb to these new highs, and I always hear this: "Well, we got to get out because it's going to go down," or whenever it's selling off, we got to do something, right? Again, sometimes just sitting still is the best idea, right? And learning how to ride things through, because again, business is cycle, right? So yes, I think that when you look at your statement, you see that there's a loss there. That's real. I don't want to try to negate that, but it's not accepted, right? Once you accept it, then it's the real deal. Now you have less money than what you started with.
In the past, the market has shown that it bounces back. Do you think this time is any different, or do you think that's what we're expecting? Because it's eventually going to bounce back.
So to answer your question, no, I don't think this time is different. So if you look at from 1980 till 2021, right, we have 7 negative years. There's only one time period in there where we had multiple negative years, and that was kind of a perfect storm of events, right? That's 2000, 2001, 2002. We had the dot-com bubble burst in 2000, and then 2001 we had terrorist attacks, that took down the World Trade Center, and then we had a little bit of a recession shortly in there somewhere as well. But we very quickly came back and started to grow. If you look at, the last recession, what they call the Great Recession, which again, there's no reason to call anything great or mediocre or anything like that. It just is a recession. There's nothing that makes it more significant than the last, other than, the turmoil that it creates, perhaps. And so when we look at the last recession, we saw the market sell off quite a bit in 2008 and into the beginning of 2009. But by the end of 2009, it had already started moving back to the positive. So other than 2000, 2001, 2002, really pretty much every year following a negative event, we see the market move back to the positive. So do I think that this time is different? I don't think this time is different, right? You hear a lot of fear mongering. You hear a lot of people talking about inflation, stagflation, stuff like that. This is not the 70s repeating itself. We're in a very different situation economically. Consumers are in a very different situation than they were back then. And the Fed Reserve Board that we have is very smart, in my opinion. I think they're very well calculated. And a lot of people want to say they're going to push us off into recession, that kind of stuff. We don't know yet. And it's a bit too early to say. You can't look at these time periods and always expect the worst. So yes, I think that it's very likely that we see the market turn and move back to the positive, sometime here over the next little bit. Exactly when that happens, nobody really knows, right? A lot of it has to do with momentum and a lot of different factors. So we look for market bottoms, based on short-term indicators, what we call technical indicators and stuff like that. So we look for a market bottom in those, but that's not 100% accurate. But, we can look at the marketplace and we can say, all right, if we have good quality companies and we own good quality investments, right, that have a proven track record, and, if you're using product from those companies on a regular basis, then they're likely going to increase their sales and their stock price is likely going to increase, right? Especially if they don't carry debt. If they don't have debt, they can't go bankrupt. In fact, you get an award, I think, if you go bankrupt and have no debt. So, remembering that you own companies and businesses cycle through good times and bad times, right? So if you're a business owner, you recognize that. If you've even worked for a company, you recognize that there's a business cycle and the market goes through those business cycles. And oftentimes we talk about the market in an abstract idea that it's this Las Vegas style of, making money. It's not gambling, We're buying things, we're buying companies. And so recognizing that you have those, recognizing what you own and knowing why you own it. I think is most important. But no, I don't think this time is different.
Let's kind of turn over right now to talking about a family's capital.
Uh-huh.
Okay, so what are the main risks to the family's capital?
Yeah, so when you're looking at families and you're looking at clients, right? They have four main risks when it comes to their money, right? You have market risk, and that's generally the easiest one to control. Market risk is about having good quality investments that are diversified. We have more long-term strategy. And when we're talking long-term, we're talking like a 3 to 5 year outlook, right? A lot of people think that long-term is 10, 20, 30 years. And while that may be true to an extent, it doesn't have to be that long, right? So we move through markets very quickly. So market risk is the easiest one to deal with, right? The other ones are liability risk, tax risk, and creditor risk, right? So if you own a business, how are you protected? What kind of business entities do you have? What's your liability risk, right? As you roll into retirement, the latter stages of your life, healthcare becomes very costly. And if you're healthy, it costs you even more, right? Because we live longer. And so therefore it's going to cost us more money, right? So we look at all those aspects and say, how do we seam all of those up? How do we seam up all these potential potholes that can drain our capital? And then how do we get growth from there? How do we take everything in your financial picture, put it all on the same page, working towards the same goals, right? If we do that, and we do that well, then I can say with a fair amount of certainty that we'll hit those goals, right? Barring something completely unexpected.
Jason, you've given me a lot of great information today, and I know you've given your clients a lot of great information as well. Are there any final words you'd like to say to your clients during this time?
I mean, I think we pretty much covered, all the ins and outs, talking about volatility, talking about the current time period. So, the bottom line is that know that we're here, know we're taking care of you. We're constantly watching stuff, and we're going to keep you informed of stuff. And if we see things that need to be changed, we're reaching out to you.